welcome everybody to our first Friday webinar. We love doing these. This is probably our third or fourth webinar now, isn't it, Parker?
Yeah.
So Parker and I, just as a quick introduction, I'm a real estate agent in the Atlanta area. I focus a lot on Lake Lanier and luxury properties. Grew up in Atlanta and know it really well. But Parker is our preferred loan partner. He works with a lot of my clients and a lot of other clients all around the country. He and I connected for the first time in Memphis over about a decade ago, I guess.
Yeah, just over a decade. Oh yeah, right at a decade. That's crazy.
And we were both in education. I was starting charter school, high school, and he was a teacher when he started out at a middle school charter school for boys. And we got really involved with education and caring a lot for kids and helping build their dreams. Now we get to do the same thing with real estate and helping you as you're growing in your life trajectory, buy and sell real estate to help meet those goals.
Yeah, actually, I was thinking about this the other day. Is one of the joys of education is equipping students with the tools and skills that they need in order to be incredibly successful and to build for themselves the life and the legacy that they want. And I will say that going from education like you and I did to the real estate world might seem like it's not adjacent to one another, but if you think about it, I really do believe that as we are helping folks find homes and become homeowners or stay homeowners, that is, as you'll see today in our webinar, I mean, one of the most important tools or skills that you can have that's really going to set you up to have, a really rich and fulfilling life and to have a legacy that you can leave behind for your family. So I don't think it's that far apart from what we were doing.
Definitely. I 100% agree. And I think as I reflect on all the things I've done in my life to get me to where I am now, I think that's definitely something that has helped been a stepping stone, as well as help build my heart and my passion around the work I do to help people as they are getting into home ownership.
Yeah. All right. So without further ado, let me try to share my screen. That will be more successful, I would hope, than Facebook. All right. I think it worked great. Let me also go right here. We'll play from the beginning. All right, Ashley, do you want to kick us off with the title for this first Friday's webinar?
Yes, of course. Okay, so this first Friday, we are focusing on how to finance your real estate needs. And you can see the subtitle there, Finding the Perfect Loan for Your Unique Home Buying Needs, because I can tell you of all the clients I've ever worked with, every single person financed their transaction in a different way. And so everybody is very unique, has different life situations going on or different money situations going on. And so we're going to talk about a lot of those different situations that I've encountered with my clients, and Parker, who works with even more people who are actually getting loans, to talk about his experiences on what types of loans might be best for your needs. And then also we will talk about sometimes we decide to refinance or not refinance, or what to do with some extra money. So we'll talk a little bit about that too if we have some time.
Awesome.
And Parker is going to be our star today. So it's really going to be Parker. I'm sure I'll have a lot of questions for him. And if you guys have any, please put them in the chat box. I'll be monitoring that throughout. I'll either wait till the end to ask some questions, or if it seems like it makes sense, Parker, if you don't mind, in a certain moment, I might ask you a question from somebody in the webinar then too.
Absolutely. I think that's a great idea.
Great. All right. Well, welcome. We've already done this. I think we're ready to get started.
Yeah, you get to see our pictures. Okay, so let's talk about the three big things, the buckets that we're going to tackle today. Number one, loan types. Number two, buying points. Number three, time and market. If you only understood one or two words out of what I just said, that's okay. You're going to understand all the words that I just said once we get to the end of today's webinar. But first, let's talk about loan types. Now, when we're talking about loan types, it doesn't matter what type of loan you get, you're going to have an interest rate. And I know that interest rates have really been making a lot of headlines. We are in a high interest rate environment, especially if you look at just the last 10 years. There's a lot of headlines about the Fed raising their rate, about inflation. And we kind of got spoiled. Is even before COVID, we had rates in the 3s and the 4s. And then when COVID hit, they were in the 2s, the really, really low 3s. And now we're in the mid 6s to the mid 7s. But this is what I wanted to show folks. And there are going to be 3 slides here. One, let's talk about rates from 1971 to 2019, AKA before COVID-19. You can see that in the early 1970s, we were at about a 7%. And then what happened? Well, if you were alive in the 70s, I was born in the 80s, so I was not. You'll probably remember that right around here, this is during the Jimmy Carter administration, you had rampant runaway inflation. Stuff was becoming more expensive to buy. And so how do you fight inflation? Well, you fight inflation. Well, how we fought inflation back in the late 70s, early 80s is how we're fighting inflation now. The Fed, or the Federal Reserve, they're going to make it more expensive for banks to borrow money, which means it's going to be harder for banks to lend money to other folks to go out and try to start businesses or hire or whatever. So you can see that from 1971, and it really peaked in the early 80s. That's right, we had interest rates that were like 17, 18%. And now what happens? They start to go down, they start to go down, they start to go down. So by the time we get to 2019, we're about a 5%. So actually, if we're at a 7% environment now, you can see that we are still, if you look from 1971 to today, we're doing pretty well. This next graph actually shows, though, what happened in 2019. So once COVID hit, this is what happened. You can see that it really kind of bottomed out. Let's look at just the blue line. This is a 30-year fixed rate mortgage. You can see that we really dipped below 3 right at the beginning of 2021, okay? And then look what's happened in 2022. It's gone up, up, up. So now we are at a 6 and close to a 6.5, a little over 6.5, a 6.66%. So that's why people feel like the rates are the highest they've ever been. It's because, well, in the last 2 years, we've had a ton of movement. But let's contextualize that. 1971, today. So Ashley, if you were an alien coming down to Earth and I were to show you this chart, how would you categorize or talk about a 6.6% interest rate?
I would say it's about, maybe average or a little bit below average from the rates over the past 45 to 50 years, it looks like to me.
Yeah, absolutely. Not only that, and this is what I want to get people potentially excited for. Ashley, do you see these kind of gray, it's kind of hard to see, but you see these gray lines? This represents recession, all right? Now, what is a recession? A recession is when our GDP, our gross domestic product, that's when that starts to shrink. It's when production in a country shrinks. And look what happens. You have a recession, and look at where rates, we had a rate spike here.
Yeah.
Recession happens, rates go down. Yay, life is good, rates are going up. Recession happens, look what immediately happens, goes down. Life is good, recession happens, rate goes down. Life is good, recession, rates go down. Life is good, recession, rates go down. So now, look here, it's been a hot second since we've had a recession. Most economists do think we are headed into a recession, not like the one that we had in 2008, 2009, 2010. They call it like a necessary recession, mainly because you would rather pay the short-term cost of maybe money getting a little bit tight, the economy slowing down, because what's the alternative? The alternative is things continue to become 8% more expensive from now until eternity. And believe me, if you think a recession's bad, just study like Germany after World War I, where you literally had to have a wheelbarrow of money in order to buy bread. Like, inflation absolutely is the destroyer of economies. So recessions stink, but the Fed is doing what they need and are supposed to do, which is we've got to get inflation under control, or what's going to happen will be way worse than a recession. But I say that because, look, Ashley, we've seen that when a recession does happen, what happens to mortgage rates? They go down.
They go down.
That's right.
And so
So,
maybe there, since there hasn't been a recession in a while, there may be one coming. Is that kind of what one of the things you were trying to say too, that
mhm.
possibly sooner than later we'll start seeing the rates, even though they're still not at a super high rate compared to historical timeframes, we might see some downward movement in those rates again in the near future?
Absolutely. As soon as, if and when, mostly when we get into an official recession and the economy starts to shrink,
Mhm.
you will start to see mortgage rates go down. Why? Well, once we go into recession and inflation gets under control, the Federal Reserve, they're going to want to stimulate growth in the economy. And what's one way to stimulate growth? It's to make money cheap to borrow. And that's what an interest rate is. That's what a mortgage rate is. It's an interest rate percent. I
Mm.
do now, with that context, and this will make even more sense when we talk about buying points. I do want to go through these 4 buckets when it comes to our first big bucket, which is like, what are the different loan types available? So we're going to talk about a variety of loan programs. We're going to talk about fixed versus ARMs versus buy downs. We're going to talk about delayed financing, and then we're going to talk about second lien HELOC, aka what I lovingly call the jumbo buster. So let's get
Okay.
into variety of loan programs. I'm going to spend very little time here, and here's why. Almost any lender, almost any lender is going to take your loan application and they're going to say, hey, we can go conventional, or we can go FHA, or we can go VA, we can go USDA. These are your bread and butter basic loan programs, loan types. So that's why I'm not going to spend a ton of time, because at the end of the day, when we talk about being creative with your financing, it's not about, should I go conventional or should I go FHA? It's about how you construct the loan within that loan program. Okay.
Right. Okay.
So when we talk about a conventional loan, usually a conventional loan is going to be attractive to folks because if you do a 20% down payment, you don't pay mortgage insurance, aka it makes your monthly payment cheaper. Conventional loans, a lot less red tape than most loan programs, but it is a little bit tougher to qualify for. And unless you have exceptional credit, your interest rate is going to be higher than, say, an FHA or a VA or a government-backed loan. When we talk about a jumbo loan, all a jumbo loan means is there's something called a conforming loan limit, aka the maximum amount of money that you can borrow and it still be federally regulated and protected. And so that actually was raised to 710,000. Well, if you're borrowing more than 710,000, you got to go to private, into essentially private money. And so jumbo
Mhm.
loans, pretty tough to qualify for, usually a little bit higher interest rate. But if you're trying to buy that $2 million dream lake home, well, it's still a good investment, and you might have to go jumbo. I'm not going to spend a ton of time on jumbo though. And then we've got our FHA, VA, and our USDA loans. These are all government-backed and government-insured loans. FHA, 3.5% down payment, usually reserved for first-time home buyers. VA is for our veterans. USDA is if you're buying a home in a rural area and if you're below a certain income level. I've got some great resources that we can send out with the handout. That's just essentially one-page cheat sheets for these different loan products. You take 3 seconds, even if you know nothing about mortgages, you'll be able to understand the differences very quickly. And what I mean by self-employed, that's not necessarily a loan program, but we do have some really innovative options that are in the private money space for folks who are self-employed or own their own business who maybe can't get qualified for these more traditional types. So loan programs, I'll send you the one-pagers, but that's not the fun stuff to talk about, or really, I would argue, the most important thing to talk about. Now we start to get to the interesting stuff. So let's talk about fixed versus ARM versus a buy down. What do I mean when I say a fixed rate? What this means is that if you get a 30-year fixed rate mortgage, that interest rate, let's say it's a 5%, that interest rate is never, ever going to change, ever. So you don't have to worry about it. If you do a 30-year fixed loan at a 5%, you can have 5% till the cows come home. Now, when I talk about an ARM stands for an adjustable rate mortgage. That's where you're going to have a low introductory rate for a set number of years before you move to the current market. ARMs are really popular right now. For example, a 5-year ARM, let's say you get a 5% interest rate on a 5-year ARM. What that means is that you're going to have that 5% for 5 years. Then after 5 years, whatever the market's at, that's where your rate's going to go. This is really popular right now because people are betting that within the next 3, 4, 5, 6, 7 years, rates are going to go down and they'll be able to refinance to a fixed rate mortgage. That's what an ARM is.
And
then
you
last,
know, Parker, sorry to interrupt you, but when I bought my very first home, I couldn't really afford, it was tough because it was my first home, right? And first job and everything. So I got an ARM for a 5-year ARM for my mortgage because I thought, well, this is a starter home. So most likely I'll probably sell it within 5 years. But to your point, even if I don't, by then I'll be making more money and or the interest rate will go down, where I
right.
can refinance and afford my mortgage. And so it was a really great option for me as a first-time home buyer as well.
Yeah, absolutely. Absolutely. That's a great point. And then last but not least, we have buy downs. Buy downs are where a third party, when I say third party, it can be the lender, the seller, or the realtor, but it can't be you, the borrower, for reasons we won't get into. But what a buy down, you have either a 1-0 buy down or a 2-1-0 buy down. What does that mean? What that means is, let's say that I'm like, hey, right now I can give you a 7% interest rate. But if we do a 2-1 buy down, what that means is that your first year with the mortgage, you're not going to pay payments based on a 7% interest rate. It'd be a 5% interest rate. That's why it's called a 2-1, right? Whatever your interest rate is, go down 2. So it'd be at 5%. The next year, it'd be at a 6%. And then the third year, you'd be back at your note rate of 7%. People really like buy downs because it gives you 1 to 2 years of lower payments in a higher interest rate environment. Or I actually did a buy down, Ashley, for somebody who was in their last year of residency. So they knew that they were about to finish their residency as a physician. They knew that they were about to get a huge pay bump. And so they wanted to go ahead and buy this house, but they couldn't really afford, or they didn't want to afford, the mortgage payment at the note rate. So they did a 2-1 buy down. Worked out great for them because this doctor knew that within the next 1 to 2 years, she was going to be making, substantially more money than she would be in residency. So those are the three. So, and here's the great news: FHA, VA, USDA, conventional, jumbo, all those different loan programs back here, they all come in these different sub shadings. You can get a fixed rate, you can do the ARM, you can go to a buy down. So whether or not you're using me as your lender, if your lender that you're going with says, hey, let's do an FHA loan, say, awesome. I'd love to hear about your 2-1 buy down option for an FHA, or like, hey, what are your ARM rates looking like for FHA? So just make sure that especially in this higher interest rate environment where we're pretty sure rates will go down the next 2 years, look into your ARMs and look into your buy downs. It may be a really, really good option for you. Okay, delayed financing. This is a fun one. Actually, we haven't done one of these together. I'm really hoping somebody watching this webinar will let us do this with them. So here's what delayed financing is. The best way to wrap your brain around it is it's essentially, people know it like, I'm going to do a 20% down payment. Well, this is like a reverse 20% down payment loan. What do I mean by that? Ashley, let's say that you get $1 million in cash, or let's say you have $1 million in your brokerage account. And let's say that you find an $800,000, no, let's do the math easy. Let's say you find a $1 million home. Well, just because you've got $1 million in cash and can buy that $1 million home, and a home's a great investment, you probably want to keep that $1 million or as much of it as you can in that brokerage account so it can continue to grow in the market. That being said, oh man, nothing is more attractive to a seller than an all cash offer. So what could you do? Well, what you could do is you could buy the home with all cash. You're signing the docs. Yay, I own the home. Go take a little bathroom break, get some water, come right back, and then immediately do what's technically a cash out refinance, to where you're getting 80% of your dollars back. And so if you're buying $1 million home, you buy that $1 million home with cash, go take a bathroom break, come back, you're going to get $800,000 back. You can put it right back into your brokerage account. And then your loan amount is obviously $800,000. And then you would make your payment based on that. Here's the other cool thing too. Let's say that you don't want to get 80% of your money back. Let's say that you're like, you know what, I'm going to buy this $1 million home. I really only want about $300,000 back. Great. Like you can get as much of your money back as you want, and you can have your loan amount be as much as you want it to be. So that's delayed financing. Doesn't that sound cool? I feel like we should do one of these with one of your clients, especially with a lake property.
Yeah, I actually think you may have suggested this to a couple people, but they found other ways around it. So I have a question based on that
Sure.
though. What would be the benefit of doing that? Like taking my $1 million to pay for the house, go to the bathroom, and then I come back and I've got 800,000
Right.
versus me just taking $200,000 out of my brokerage account to get a loan.
Yeah, it's a really great question. So you are getting a loan, obviously, it's just delayed. That's why it's called delayed financing. But really, actually, this is why you need a really great realtor like you, because you got to fill up the sellers. Like, especially if it's in a crazy hot market, you might have listing agents who are just straight up saying like, yeah, we've already got like 3 cash offers. So you can submit your offer with financing, but like we're only going to do cash offers. Or when the market's slower, you might be able to come and say like, hey, I'm going to buy this all cash. I'll close in 10 days, but I want you to cover closing costs and we're offering 20K under list, right?
Perfect.
At
Yep.
the end of the day, cash is king.
Yep.
And as the market cools off, people who can continue to be cash buyers are going to be able to get the best deals. Did I answer your question?
You did. Thank you.
Of course. Last of this big takeaway, it's called the second lien HELOC or a jumbo buster. A HELOC is a home equity line of credit. So here's what you think, Ashley, if you have $100,000 home, it's worth $100,000 and you owe $20,000 on it. What a HELOC, home equity line of credit, allows you to do is you can go up to 90% of the value of your home. $100,000 home, you owe $20,000 on it. 90% of a $100,000 home is $90,000, which means that your home equity line of credit would be up to $90,000 minus your loan amount, aka you're essentially are going to have $70,000 that you can tap into, and it works just like a credit card, but it's at a super low interest rate because your house is being leveraged as collateral. That's how you're able to get. And what I love about HELOC, super flexible. Like my wife and I, we opened up a HELOC and not even to use it. It's just a really great emergency kind of fund to have. And if you do need to use it, well, you get to write off the interest, and the interest is going to be way lower than like a credit card. That being said, why is it called a jumbo buster? Well, if you're trying to buy a home that's like $2 million, no, I'm sorry. If you're trying to buy a home that's that's $1 million, well, you're probably going to have to do a jumbo loan unless you can get down to that $710,000 mark. So what a jumbo buster does is you're going to make that 20% down payment, but 10% of that 20% down payment is actually going to come from a HELOC that you open up on closing day along with your primary loan. What are the benefits of that? Well, if you're making a 20% down payment, but you're only having to bring 10% of your own cash, that's cash and money that you get to save. But what I love about it is once you've paid off that HELOC balance, you've got this substantial line of credit that you can then use to renovate your house or use it to buy an investment property. So it allows you to break up having to do a jumbo loan, protects, it essentially allows you to make a 20% down payment, but only use 10% of your own funds. And then once you pay off this HELOC that you're opening up the same day you're closing, that's going to give you it's going to give you the same flexibility of a HELOC down the road.
Okay, so I at first understood this to say I would open a HELOC on my existing home, not my new $1 million home. But what you're saying is I'm opening this HELOC on my new home I'm about to buy, and it opens on the day I close.
That's exactly right. Yeah,
that's cool.
That's cool. Because think about it, your HELOC, you can go up to 90% of the value of your home. And so that's the reason why you've got to do at least a 10% down payment, because you got to put at least 10% of your own skin in the game to get that 90% value mark. Sure. And then you can go the rest of the way down to the 80% LTV with your HELOC. It's really cool. I've done 2 of these and they've been really, really fun to do. But you got to wrap your brain around it. But it's a strategy that I really want to make sure that people know is available to them, because you can pair this with any loan type. So
and basically someone's going to choose that strategy because they don't necessarily want to put $200,000 down on their $1 million home, but they want to put, 20, yeah. Or they actually just want to put $100,000 down, and then they've still got that $100,000 to use for whatever they might need to use it for, pay for their kids' college, a new car they gotta buy later on.
Or maybe right now the market's down like 20-25%. And so maybe you just don't want to have to sell your stock at a deep discount. You want to try to keep it in as long as you can. But yeah, this is just a really good way to not have you have to burn so much of your own assets up front.
Yep, great.
Key takeaway, you have lots of options. You can be creative. As you can see, everything that I just talked about, you can do all of these strategies within each of those different main loan types. So,
and I'm going to add a little plug for you, Parker, here, because there are lots of options and so many more than what Parker just went over. He is, my clients who have had to work with him through their unique situations have all said how very creative Parker is. So make sure whoever your loan officer is that you're working with is being creative, because you as a buyer, as a person, just a normal person in the real estate market, you're not going to even know what you can be creative with, but someone like Parker can, and really work with you to maximize your unique situation.
Also, and thank you, Ashley, for saying that, but also if you're a higher net worth individual and you're trying to buy in the luxury market, I'm telling you right now, the fastest and easiest path to the closing table is probably not going to be the best path to the closing table. And I'm defining best as in what's going to be the best for you and your finances long term. So thank you for saying that. Unfortunately, creativity does take some time, which is why a lot of lenders don't like to do it, because they just want to get the deal done. Yeah. All right, so now let's talk about our next. I've been hearing, excuse me, oh my goodness, all my clients right now, Ashley, all they want to do is they're like, how much does it cost to buy down? I want to buy down the rate. 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 So before I even start breaking down this chart, I'm actually going to go back to right here. Remember these gray lines?
Yeah.
Recessions happen. It's been a second, Ashley. It looks like we're due for one. And what happens after recession? Rates go down. So keep that in mind. Keep that in mind. Let's break down these numbers. So what do I mean when I say a point? A point does not mean a percentage point. All a point means it's the cost of lowering your interest rate. When I say 1 point, what I mean is 1% of your loan amount. So if you're buying a $1 million home and you're putting 20% down, and you say, how much does it cost to buy down my rate? And it's like, well, it's going to cost you 1 point. You need to do 1% of $800,000. So $8,000. So 1.1 equals 1% of your loan amount. With that being said, let's compare here for a second. So let's say that I've got 7% interest rate. No points mean I'm not buying my rate down. I've got a $600,000 loan. It's a 30-year fixed rate mortgage. I'm not paying any points. It's not costing me any money. My monthly mortgage payment, $3,992.
Parker?
So yeah.
I just want to clarify a couple things real quick. So the loan in this chart, we're talking about a loan amount, not a home amount, correct?
That's right. This is the loan. This is how much you owe after your down payment.
Great. And then the other thing I just want to clarify, guys, we have handouts that go along with this webinar. So if you have not downloaded yours, be sure to go back to firstfriday.com, firstfridayrealestate.com, and download that handout. So all of this, if it seems overwhelming as we go through, ask questions, but also the handout will walk you through this very clearly.
Awesome. Thank you, Esther. That's a great point. So speaking of points, right, is we've got this. Now, let's say that we wanted to get down to a 6% interest rate. And let's say that's going to cost us 1.5 points or 1.5% of our loan amount. That's going to cost us $9,000. So if you pay an extra $9,000 at the closing table, lower interest rate, what does that do to our monthly mortgage payment? Oh, it goes down like $400. Yeah. So that's really where most of my borrowers' understanding ends. They're like, no brainer. I want to pay $400 less a month. But you're not just doing that, right? You're having to pay $9,000 up front. That's an investment. You're investing in a lower rate, which means it's going to take a little bit of time for that upfront investment to get paid for with your monthly savings. Next chart shows what I mean by that. So let's talk about still same loan, same scenario, 7% rate, loan amount 600,000, points, buy down costs, payment, total payments, total interest over the life of the loan. So what do we got here? We've got total payments, $1,437,053. Total interest, $837. You pay that $9,000, payment goes down. You're like, oh my gosh, I'm saving almost $100,000 in payments. Oh my gosh, I'm saving, $200,000+ in total interest over, again, life of the loan. That's 30 years. 30 years is a long time, Ashley. But still, you look at these numbers, let's say that you're a borrower who's got a little bit better understanding than the previous chart. You still do this math and you're like, oh man, I'm coming out like gangbusters. That's a great use of my $9,000. But now let's go to the next. So let's talk about what happens if you spend that $9,000. Points save you. If you have no points, nothing. With points, you're saving $395 a month in your mortgage payment. But how long is it going to take for those monthly savings to pay for that $9,000 investment? Well, 23 months or 2 years, meaning all these savings that you're obsessed with that cost you $9,000, it's going to take you 2 years for those savings to have paid for that $9,000 investment. So that makes sense. Cool, great. Let's keep going.
It makes sense. I do have a, well,
Sure.
you answer this and then, because we actually had a question earlier on about that buy down that you were talking about.
Okay.
And so maybe I'll ask it now because I feel like it kind of might be applicable.
Sure.
Is this the same concept? Like if they did a 2-1 or a 1-0 buy down, is this the same thing you're talking about, or is this different as far as what they
super different. A buy down is going to be temporary, right? It's a temporarily lower rate. So a 2-1 is if I'm at 7% and I do a 2-1 buy down, first year I'm at 5%, second year I'm at 6%, then I'm back to the 7. The other big difference is this right here. This is my own money, but you're permanently buying down the rate. With a buy down, a third party has to pay that cost to get you that temporarily lower rate. Does that answer the question?
Yeah, so yeah, it does, because they were asking how would they go about doing that. So I think that answers the question, and it also, for me, shows the difference of what a buy down as a mortgage option is versus actually buying down the rate.
Yeah, that's a great question. I'm so glad they said that. So now here's the other thing that my clients will oftentimes do. They're like, all right, I've got $9,000. Maybe I don't want to pay down my rate. You know what I'm going to do? I hear this all the time. I'm just going to add that as an extra loan payment. So I'm just going to put more money down. I'm not going to buy down my rate. I'm just going to do more money down, meaning I'm going to owe less money. Well, that sounds awesome. Here's the thing. It doesn't lower your payment much at all, but also your total payments and your total interest. Well, we're about to compare it on the next screen. All right. So in reality, if you do the math, for you to pay $9,000 towards your loan, it's going to take you 27 months for your savings to have paid for that $9,000 investment versus lowering your interest rate. You're actually going to pay that your savings will have paid for that initial $9,000 investment more quickly than if you had reduced your mortgage. All right. So again, you got to do your math, because in this scenario, people are like, wait a second, I could owe the bank $591,000, or I could owe the bank $600,000. Owing the bank less, that's a better thing. Ironically, if you're spending that $9,000 to just drive down your loan amount, the bank's actually going to be getting more money over the life of the loan than if you were to just bought down your interest rate. Does that make sense?
Yeah, that's really interesting. And I'm wondering, so I guess if you have to make a decision, someone like you could also run these numbers for them and help them see how long it's going to take them to break even, right?
Yeah,
but then I'm
absolutely.
Wondering personally, okay, but I have $9,000. Is there a better way for me to use that money if it's going to take 2 years for me to even see a benefit?
Oh, I'm so glad you asked. So actually, I'm not going to go to that slide yet.
Okay, well, we'll come back to that because I'm wondering about it right now.
Yeah, so this is the question I want people to ask themselves. And I'm not going to go all the way back to that to the recession slide with the different rates.
Mhm.
But really the bet you've got to decide for yourself is, will this 6%, let me try to get a little laser pointer here. Yeah. Will this 6%, will I be able to get this rate for free? And I'm going to do free. I'll say that in a second. Would I be able to get a 6% for free within the next 2 years? AKA, if I just sit on that 7%, if we're really going into recession, that means rates are going to go down probably even lower than a 6%. So what can I do? Can I get that rate? The answer is yes. It's called refinancing. There's even something called a streamline refinance, to where you've paid no money to get to 7%. You wait like 12 months, right? All of a sudden, recession, rates are going down. You can call me and say, hey, what are rates right now? I'm like, oh, they're at a 5.5%. You're like, well, could I refinance to that? I'm like, sure. Like, how much does it cost? They're like, oh, you got to pay the attorney, but you can just roll that cost into your new loan amount. And guess what just happened? You actually, by not buying down your rate, by not spending that extra $9,000, you were able to accomplish like the exact same thing, but for way less money, just because you realized that a recession was probably coming and you realized that rates were probably going down. That being said, Ashley, there is no crystal ball, right? And so when it comes to 23 months, so what? You know what? Like, at the end of the day, if that's what's going to make you sleep better at night, that's not a bad investment. Personally, though, I just purchased an investment property with my wife. We did not pay any points, because I really do think rates are about as high as they're going to go. And I think they're going to start coming down once we're in a recession. So I didn't want to have to pay money for a rate that I can just get for free when I refinance in a year or so. Does that make sense?
Totally.
I want to show this. This is a different scenario, but I think it's pretty cool. So let's talk about, we've got a 5-point reduction. It's like, I want to buy down my rate from a 7% to a 5%. How much is that going to cost? So say you're the buyer, Ashley. I'm like, Ashley, guess what? You're pre-approved 7%. You're like, Parker, I'm obsessed with the number 5. I've got to have a 5% interest rate. Actually, you wouldn't be surprised. You know how folks get some, there's like, it's my lucky number. Like, I've got to have it. So cool. So to get to a 5% interest rate, you would have to spend 5 points, or that's 5% of $600,000, $30,000. Now you look at the payment, your monthly mortgage payment's going down a ton, but actually look how long it's going to take you to recover your costs.
More than 3 years.
Yeah, that's even worse. Let's say that you're like, I want to put my extra $30,000, I want to reduce my loan. Look how long it's going to take you to recover that cost.
Yeah.
So here's the question, Ashley, and this, we have $30,000. This is where you as an individual need to say, like, okay, can I take that $30,000 and can I get a better return on investment elsewhere? Or not better, better is the wrong word. Can I get an equivalent, or maybe even the same, but faster? Because waiting 39 to 53 months, that's, that's not nothing. And that's just to break even, right? So hopefully this chart, the reason I just wanted to show and kind of, we went from the basic understanding that most people have to now the more complex understanding of realizing, what, if you're saying, should I buy down my interest rate? What's my takeaway, Ashley? Do the math before you pay the points. And you're like, but I don't know how to do the math. Well, just give me a call. I've got lots of fun widgets and I've got some experience, and we can just figure that out for you. We're not going to steer you wrong.
Great. I got another question for you, Parker. Can you go back to those previous slide?
Yeah. Okay.
So this is like a personal question just based on conversations that Parker and I have normally, but if you have, let's say, $40,000 of credit card debt.
Okay.
And because of that, I'm assuming then your credit score is not going to be as good. So maybe your interest rate that you get on your loan anyway is not going to be as good as it could be. But then in this case, I think we would always say, hey, if you can choose to pay down your points or pay off your credit card, you're going to get a bigger bang for your buck and just for your financial health, right? By paying down that credit card. So I see you nodding yes, great. And so then my next question is, I get all my credit card debt paid off, in a short period of time now, because I just came upon this money and I'm glad to pay that down. Would I be able to, would it even be worth it at that point to consider refinancing for a better rate now that my credit is better?
Yeah, that's a great question. If your credit's better, so let's define better for a second. If you've got like a 620 credit score and you barely got pre-qualified, and all of a sudden you pay off all this debt and you're like above a 740, probably the rule of thumb is you do not want to, like, refinancing is not worth it, because there are costs associated with refinancing. You don't have to bring any of your money, just those costs are rolled into your new loan amount.
Right.
And so the rule of thumb is you don't want to refinance unless you're lowering your interest rate by at least 1%.
Okay.
So if you get a quote, and if you can, by having better credit, if you can lower your interest rate by 1%, do it without even hesitating, because you'll actually recoup the costs. I keep saying costs. It's just cost financing to your new loan. You'll recoup those costs in less than a year. That's the rule of thumb. You lower it by 1 point, you'll recoup the refinancing costs that were financed into your new loan amount in less than a year. But let me also answer that question a slightly different way.
Sure.
So it's baseball season. There is a phrase I love in baseball. It's called "Don't swing yourself out of a game." And as we know, pitch count, how many pitches a pitcher can pitch, that is really important. The higher the pitch count, the more fatigued the pitcher gets. And so if you've got an amazing pitcher like Jacob deGrom, or for the Braves, Max Fried, our ace, if you're facing Max Fried, right, when they're saying don't swing yourself out of the game, meaning Max Fried is going to be amazing. He's going to be difficult to hit. And so you want to get Max Fried out of the game, maybe not by scoring a bunch of runs on him, but you want to get him out of the game by running his pitch count up. And so if you're swinging at every single pitch, well, then before you know it, Max Fried pitched all 9 innings and his pitch count never got above like an 80, right? So what do I mean by that? What I mean by that is, let's say that is your strategy, and your strategy is, okay, it's Max Fried, we're trying to beat him, we're not going to swing ourselves out of the game. That's an amazing long-term strategy. But let's say, Ashley, that the Braves offense, which is prolific this year, by the way, let's say that they come out and all of a sudden you're down 8-0, right?
Yeah.
Well, here's the thing. Does your long-term strategy still make sense? The answer is no. You can't wait. Like, you can't try to make up 8 runs in 3 innings. So what that means is you kind of got to pivot. You got to do a different strategy, because at the end of the day, you sticking to your long-term strategy where you're down 8-0 in like the 2nd inning, it's just going to end up with you losing the game. Right. So at that point, you got to take the risk, and you got to start being aggressive and swing, and just hope that Max Fried makes some mistakes so that you can make up some runs. And then let's say you do get lucky, you hit a home run or 2, then you can pivot back to your long-term strategy and try to run up his pitch count. So when you gave that example from that question, I thought about that, because I've seen people, Ashley, who've got $40,000, $50,000 in credit card debt, and they're having to do like $600 a month in minimum payment. So it's not even like, and they've got enough money for a down payment and then some, and they're like, no, I want to do a 20% down payment. I'm like, no, do a 5% down payment and pay off your credit card debt. It's like, no, it's like, because they're like, well, over 30 years, I'm going to be paying way more money unless I do this down payment. I'm like, well, you're not going to be in your house for 30 years if you continue to have $50,000, $60,000 in credit card debt. So you got to, at that point, sacrifice long-term strategy to try to get rid of that credit card debt. It's probably got like a 22% APR, and that's going to be a much better decision than trying to use that money to not pay off credit card debt and just like lower your interest rate on a mortgage. Because mortgages and real estate, they're amazing long-term investments.
Yes.
Short-term, long-term. All right. Now let's talk about this. Ashley, this is our last big takeaway. It's called time in the market.
All right.
And when I say time in the market, what I just mean you got to spend time in the market. And meaning you got to own something in order to actually build equity. So
I think what you mean is, going back to that Braves metaphor, is if you don't play, you won't get paid.
That's right. Or like,
Right?
or it's just like, you know what? Let's just not play the Braves, and that way we don't even have to face Max Fried, right?
Right.
It's
But then
like,
you never make it to the World Series. You never get
yeah,
on
it's
TV.
just
Nobody
not
even
gonna
knows who
play.
you are. Yeah.
Exactly. I love how topical this has become. All right, so Ashley, you know a little bit about Forsyth County, Georgia, right? Just a little bit.
Yeah, I
Yeah.
live here. It's great, great county. And yes.
Love it. Okay, so the median sales price for Forsyth County as of last year was $546,706.
Okay.
What I want to talk about is this is live market data. It's being pulled from I think BlackRock data, and historically, you've got a four. Oh, we have a little typo here, Ashley. I totally missed that. That's okay. The big thing is like the historically forecasted value
In
is
Versailles.
it's higher, right? Forecast is about like they believe it was a 4.13%.
Okay.
That's your historical, forecasted, and then you've got your forecasted. This number is correctly. It's at the 3.13%. Don't be obsessed with these numbers because there's a typo here. Here's the main thing: if you go historically, then your return on investment is going to be even better. But I actually want us to focus on the more conservative forecasted appreciation number. So if you buy a home, $546,706. If we are being conservative, and by the way, your home appreciating 3.13%, that's it. That's underperforming the historical market for like 10 consecutive years. That's probably not going to happen. But even conservatively, your home is going to be worth $744,138.
In 10 years. That's great.
In 10 years, that's great. Gets even better. All right. So now let's talk about your equity gained and then also the appreciation. All right. So with our more conservative, when I talk about appreciation gained, that's how much your home went in value. I'm going to talk about your amortization gained. That's essentially how much you're now saving in interest that you're paying. So this is for a different webinar. Here's what you need to know. Whenever you do get a loan, the bank is going to get their interest up front. So most of your monthly payments in the first few years, it's going to be interest to the bank. It starts to tilt in your favor the longer you're in the loan. Bottom line though is that your total equity gained $258,378. You then are also getting back your initial down payment of $109,000, which means that your total equity position after 10 years, you've built up $368,442. It's money you're walking away with. That's the equity in your home. That's an amazing return on investment. You're doubling your initial seed money, which was $109,000. Now, if we go to our historical, you can see that if the market performs how it historically has, a little bit less conservative, your equity position is almost $100,000 more. Okay. Uber conservative, actually still pretty conservative. I'm showing conservative numbers on both sides. This is just like worst case scenario. And this is going to be probably more in line with what Forsyth County has historically done.
And, before you switch to the next slide, Parker, I want to call out too, I'd like to look at this to say, wow, this is how much money, basically, this is how much money I can put into my next home. Assuming you are using real estate in a very like American dream kind of way, where you're growing your family, you're growing your life, you're growing your lifestyle. And so your next home most likely will also, of course, cost a little bit more money, maybe be a little bit bigger, maybe be on a lake. And so this is a lot of money to put into your home. But even if you think about, okay, but when I sell my house, I have to pay realtor fees.
Right, right.
That realtor fee on your $744,000 home is, and you subtract that from your total equity, you're still more than doubling your initial investment. And so like, it's really a wonderful, wonderful investment to be able to then take that money and put it into whatever you're doing next.
Yeah, I love that. That's a great, people get real freaked out about, like, I pay the realtor. And it's like, listen, just people get so proud of their Robinhood brokerage accounts when they like, you're like, oh, look, it's gone up 11% in value. It's like, cool, try like, a 200% return on investment. That's,
Exactly.
that's a little bit better. Now let's talk about forecasted appreciation at a 7.125% versus a 5.125%. Now, why am I talking about this, Ashley? Here's why. So you talked about you're not going to get paid unless you play.
Yes.
So I've had people be like, you know what? I believe in home ownership. I'm all in, but I'm going to rent for the next 2 years until rates go down. Okay.
Okay.
So you're at a 7.125%. You're like, I'm going to wait 2 years until I get to my 5.125%.
Yeah.
Well, the home is still appreciating we're using the same conservative forecasted. If we're at a 7.125%, our total equity position is 368,442. If we wait until we get to that or not even wait, but if we're at that 5.125, let's say we could snap our fingers and get a 5.125, we're improving our equity position by less than $20,000.
And the reason is I'm paying less in interest, but I see your first line there, the appreciation gain remains the same, right?
That's right.
So that second one is like interest that I'm not paying because my interest rate was lower, but basically it's just less than $20,000 difference for me waiting 2 years to buy a house.
That's right. And not only this is a $20,000 difference, and it's assuming that there's a magical world where you're not waiting. You're actually just like getting the same house at a 5.125. If I were technically more savvy, then really what would show is you're buying this house at year 2, which means that you're buying the house for $576,000, which my math, I'm not,
$5,000 more. Yeah. Or $30,000.
Yeah. So you're actually like 10K in the hole.
Wow.
You're actually making 10K less.
Well, and also, what were you doing during those 2 years? Were you paying a rent or somewhere else?
And what's that rent doing? Is that building your equity? Nope.
No.
It's building somebody else's equity. That's a great point too. So you're not only 10,000 in the hole, you're probably 40,000. So by you waiting to get the lower interest rate, you're really shooting yourself in the foot. Yeah, of course. I would love to have $20,000 more dollars. I would love to get the same house at a 5.125% interest rate. But at the end of the day, you know what's way more beneficial? Play in the game. Get in the game. Get in the game at the 7.125%, because I'm telling you, and this is also assuming you don't refinance, which you'll probably refinance in the next 10 years. You can see that the math actually works out to where it was much smarter to buy the house at a lower entry price and let the market work in your favor than it was to wait for that lower interest rate.
Well, and sorry again, but you mentioned a while ago that, most likely the rates are going to go down. And it's a good idea to refinance if you can get at least a percentage rate difference, right? So if I go ahead and buy this house for $546,000 at a 7% interest rate, and then maybe after 2 years, when I would have waited, but now I don't wait, and the interest rates are down to 5%, me refinancing is going to even give me even more benefit, but to basically no cost to me, if I'm understanding what you're saying correctly.
That's exactly right. Yep, that's perfect. That's exactly right. And I think this really hammers it home, at least I hope it does. So this is the cost of waiting. So what do I mean by that? Let's talk about buying year 1 versus renting year 1. So if we're buying a home, and our monthly, this is the same home, by the way. You're buying, the 576,000. Your monthly principal and interest, 2,947. Property taxes, maintenance, repair, monthly expenses. So all in, you're paying year 1 $3,767 for your mortgage payment. You're renting year 1. It's gonna be less.
Okay.
Do you know what the national average rent increase is year after year, Ashley?
I mean, I don't. I guess 2 or 4%.
8%.
Wow. Yeah.
8. That's not even like taking into consideration the COVID spike that we've seen. So let's just say that you got some generous landlords and your rent's only increasing 6%. By the time you get to year 10, you're paying $6,000 a month in that same spot. But because you have a fixed rate mortgage, your payment doesn't go up. Look what that does to your cash flow. And I think this is good. And I apologize for not having the different colors, but we'll walk you through it here in a second. So essentially, with the big cash flow difference is by you buying the same house instead of renting that same house, you're actually over 10 years, your cash flow difference is $111,454. Not only that, but the net gain by buying the home, we're looking at this is cash flow year one. The reason it's so in the negative is because we're having down payment, right? It's your first year.
Sure.
So here's what we've got is we've got a net gain by buying home, because it's not just the cash flow that's getting better, because this was all about cash flow, Ashley. Cash flow over 10 years. This is cash flow plus how much your property is appreciating in value. All right. So you've got net gain of buying home. We're talking $343,616. That's equity. That's your net worth has gone up that much. And that's with paying the super ludicrous I would never pay a 7.125%. That's ridiculous. It's highway robbery. I don't know, making like $343,000 over a 10-year period does not sound like highway robbery to me. That sounds like, just sounds like, I'm going to keep saying it because I love it. You can't get paid unless you play.
Right.
So get in the game.
Let's say a recession doesn't occur for the next 10 years, right?
Right.
I mean, then most likely the rates, if a recession does not occur, they'll either stay the same or go up. So let's say it turns into this early 1980s situation.
Yeah.
Those rates are like 18% in 10 years. Now you could have locked into that 7% rate now.
Yeah.
We're hoping that rate will go down and you can refinance later on. But even if it doesn't, you're locking into a rate that still gives you a great return on your investment over that 10-year period. I think the other thing is if you don't play, you can't get paid, but also you've got to don't wait. The time is now.
Don't wait. Because there's a cost. There's a cost to waiting, and it's you losing a lot of money. This is a little stretched out, but I think that this illustrates, and don't worry, y'all, this is going to be in the handout, so don't try to squint and give yourself eye strain. Here's the big thing I want you to realize is if you get a loan today at that property using the 20% down payment, you're 7.125%. Let's say actually over the next 3 years, we don't have a recession, and so rates go up a little bit, like the 8.25%. Let's also say that our property value, and look how conservative these numbers are, Ashley. It's only going up like 2%, 5%. So really conservative. Just you waiting 3 years, you're paying obviously more for the same house.
Yep.
Potentially paying a slightly higher interest rate. But this is the big thing I want to show you. How much money are you losing by waiting? Well, you wait 6 months, you've lost $4,760. You wait 1 year, you've lost $15,000. You wait 2 years, you've lost $39,000. You wait 3 years, you've lost $64,000. So what I mean by you've lost that money, what I mean is, first off, you're going to have a higher payment because rates will be, even if rates aren't higher, the property's gone up at least a little bit in value. Yep. So there's loss there. That's your loss in cash flow. Also, if you lost in appreciation, meaning if you had bought the house when you wanted to buy it, you could have bought it for $11,000 cheaper, sure, but this is appreciation or equity that you've lost out on. If you own this house now, guess what? You've made yourself $11,000 in equity because it's gone up in value. So if you take into consideration payment going slightly up because the house is worth more money, if you take into consideration the appreciation of the property value that you've lost out on, and then this is a big one, amortization, aka interest that you could have been paying down, right? It starts to really balloon. And so I cannot emphasize enough, y'all, just not even professionally, personally, with my own house. Like, again, my wife and I, one of our big strategies is we really want to put our money into investment properties. We bought our very first investment property, and our rate, and this is for an investment, was a 4.25%. Obsessed with it. Amazing. Well, we just closed on our second investment property last week, and we were paid over 7%. It's almost double. But guess what? I did the numbers, and I'm like, yeah, could I gotten a better return on investment by buying this new property at a 4%? Yeah, sure. But I'm still going to be making a significant amount of money, return on investment, even at a 7+% interest rate. And so it's like, you know what 0 plus 0 is? It's $0. So if I'm not buying this investment property at a 7% interest rate because I'm like, oh, that interest rate's too high, I'm just making $0. So you're like, some money is better than no money. So this right here, this cost of waiting, this is at the higher interest rate. This is where we're at now. So just get in the game, get paid. You can't get paid unless you play. Why was that not the title of our webinar, Ashley? We really missed out.
Next time, that's what it's going to be. Can't get paid unless you play.
So here's our key takeaway. You can't, well, the key takeaway is you can't get paid unless you play. Shout out Ashley. But before we came up with that really fun one, you can't build equity in something that you don't own.
Right.
You just can't.
Right. Oh, no, I have a kind of a follow-up take on this because, I think home ownership is a great way to engage in the American dream, to like build your wealth. But I know there's plenty of people that we deal with on a daily basis who either have maybe like too much debt, credit card debt, or other types of things, or maybe just aren't in a place where they could afford this type of payment, but by renting, they could get something a little bit more affordable for them. And guys, for you, this is something we want you to be thinking about in trying to move towards in your goals. We don't expect you to like come out and say, okay, I'm going to buy this house and be above your means.
Yeah, no. Remember the short term, right? You're exactly right. Like,
yes.
don't sacrifice short-term success for a long-term strategy, because you'll just end up not ever getting to the long-term results.
Exactly. And so, but if this is something that you're even thinking or dreaming of doing, I mean, I'm Dreamsmith. I'm going to help you build your dreams. I've got a great partner here, Parker, who will sit down with you, both of us, even if you're not actively looking for a home for the next 1 to 2 years. If you tell us that, we will come up with a strategy for you and help you plan how you're going to make that happen so that you will be able to buy that home in 1 or 2 years, and maybe even sooner, based on Parker has a lot of great tools to help people, especially when it comes to debt reduction. And then we love dreaming alongside you. So
yeah, love that. I know we're a little bit over, Ashley, but I think we have time for like 1 or 2 questions, and then we can say goodbye until our next Friday.
Yeah, that sounds great. Let's see what we've got here.
I know you were kind of shouting, you were kind of peppering me with the questions as they were coming in. So
yeah, I was. I think most of them, most of what we're seeing right now is like, thanks so much. This is good information. When are we going to get the handouts?
Yeah, good question. So there were some typos. There were some typos that I discovered doing that. So I do unfortunately need to go fix those typos,
Okay.
and then we'll get an updated handout. But if you sign up for the webinar, we've got your emails, and we'll shoot that out over either this weekend or early next week.
That sounds great. Okay, so we'll definitely be sending those out to you guys. And thank you for your other questions throughout. I know I guess I mediated this a little bit differently than how you do. I peppered them in throughout instead of putting them at the end, but they just seemed so appropriate with the charts you were looking at.
That was great. I love those questions, especially about the buy down. That was really, really good. So, well, Ashley, I really appreciate you, and I hope you have a great weekend. Go Braves. And I'm excited for us to, help people get paid by making sure that they're getting in the game.
Thanks, Parker.
Awesome. Thanks.
Bye.
Bye.